Wall Street is always very conservative on their calls for higher gold price. So yeah, it is possible they're being too conservative on these calls. My call for 6,000 is not like the top that I see. Sovereign wealth funds and central banks in the Middle East, they've been buyers, not just of physical silver, but they've been buying shares of silver mines. India announced that from the 1st of April this year, you can use silver as collateral for loans. Turkey, they're buying back some of the gold that they sold because of the war. Actually said that the reason they're buying it back is because it's very good insurance, and they were able to use it during the war to support their currency. The sentiment is really bearish, and whenever that happens, things go the other way, and consolidation is like discouraging a lot of people. The EU as well is sanctioning China for selling stuff that could be used for making arms to Russia because of the war in Ukraine.
I want to start by discussing China's record imports of silver in March and what this, combined with their restriction of silver exports starting this year, means for their long-term silver strategy. I just had Eric Young on the show, and he thinks a big part of it is allowing China to diversify its energy away from hydrocarbons and more towards EVs and towards solar, and thus reduce their dependency when it comes to an energy standpoint. Wondering what your thoughts are on why you think China is placing such a big importance on silver in recent times.
Well, they like the US have placed silver on the list of critical minerals. So, and since the beginning of the year, they've put a limit on exports. And I agree with Eric. I had him on recently as well. Silver is very important for not just for alternative energy like solar, but also people are finding out you need a lot of silver for AI, for all the high tech, for batteries. There is, I think, is it a Samsung? There is or in Japan, there's a battery, free state battery or something, solid state battery. I'm not a very technical person. I'm more of a macro, but where you use a lot of silver, and batteries for electric cars are like they can run a lot longer, and the charging is a lot faster. So it's a matter of technology use and also energy. But I also think it's it's part of the monetary equation as well.
China is restricting silver exports while importing record volumes. Yet markets still price silver like surplus supply exists. As Mario Innecco points out here, silver has quietly been classified alongside critical energy inputs, not just a commodity, but a strategic bottleneck. That reframes the narrative. This isn't about green energy demand. It's about supply control during a technological arms race. For investors, that means pricing models based on industrial demand alone are dangerously incomplete. Next, Mario Innecco exposes why the industrial metal narrative breaks the moment monetary demand resurfaces simultaneously.
I've been hearing for the last 6-9 months that sovereign wealth funds and central banks in the Middle East, they've been buyers, not just of physical silver, but they've been buying shares of silver mines. There's a real rush for silver. I guess the only people that want to get rid of silver and keep the price down are people in New York and London who trade it as a speculation. But all they're doing is giving it away to our supposed opponents or enemies. Not that I'm saying these people are our enemies, but that's how we're supposed to look at them.
Yeah, some great thoughts there. I believe it's Samsung in South Korea that is developing those silver batteries. Now, you recently posted a video on your YouTube channel titled China and BRICS to Follow in India's Footsteps to Remonetize Silver. Walk us through first how India is remonetizing silver and why you think China and BRICS nations will be following their lead.
I think I just mentioned a few minutes ago that more and more countries are buying silver as a monetary asset. Don't know. You probably heard last year, India announced that from the 1st of April this year, you can use silver as collateral for loans. So I think that's what it's about, and I think China is going to do the same. Just think of it as more liquidity to the the world trading system. If you just have gold as a reserve, there's less. But if you add silver, there's more to it.
Central banks are quietly buying silver exposure while Western markets still treat it like a speculative trade. As Mario Innecco points out here, sovereign wealth funds aren't just accumulating metal, they're acquiring mining equity, signaling long-term supply positioning. That's the real tell. Insiders don't chase price, they secure future scarcity. If silver is being reintroduced as collateral, liquidity dynamics change overnight, especially for global trade flows. For investors, this isn't accumulation. It's early-stage remonetization. Next, Mario Innecco reveals the specific policy shift that could formalize silver as a parallel reserve asset.
So I think these countries, they have a tradition of looking at gold and silver as money. So I'm not surprised that tradition is reawakening, especially because the dollar, which is really ever since 1971, is nothing but like a paper promise that can't be paid back. It's like you can't extinguish a debt that is a debt, or a money that is a debt. So I think these people are starting to wake up, and I think China now is more determined than ever, seeing that the U.S. has put some sanctions on some big important refineries in China, and indirectly as well sanctions on shipbuilders in China. But China's government announced to these, because these are not state-owned, I don't think that were sanctioned. They announced to these companies, ignore the U.S. sanctions because we're sovereign and independent, and we deal with whom we want. So, and I think silver is a big part of that.
I mean, it's just so comical to see a nation that unprovoked started a war in Iran and then is now trying to sanction China because they bought Iranian oil. So that's bad. I mean, the whole thing is just so incredibly backwards. I wonder what your thoughts are, though, on the silver situation in the United States, because obviously also declared a critical mineral. Do you think they could be waking up to this monetary value in silver as well?
The dollar hasn't been backed by anything since 1971, yet markets still treat it as unquestioned collateral. As Mario Innecco points out here, countries with monetary memory are returning to gold and silver precisely as geopolitical tensions rise. But here's the contradiction. Sanctions meant to isolate are accelerating monetary independence instead. That shifts silver from commodity to strategic currency hedge in real time. For investors, this isn't theory. It's a slow migration away from dollar reliance that reprices hard assets. Next, Mario Innecco exposes how sanctions are unintentionally triggering a parallel monetary system.
Do you think they're looking at it as strictly an industrial commodity? And do you think that they're paying attention to what China's doing with its ramping up of silver imports and export restrictions? And if so, how do you think they could counter it? That was like 10 questions in one. I'm sorry. I do that sometimes, but I'd love to get your overall thoughts there.
In terms of how the U.S. perceives silver, I think the general public, a lot of them perceive it as money. The silver stackers. Let's say the administration, not so much. I think they look at it more as a critical industrial mineral, and I think they're like. They're spreading their wings, so to speak, down south in their backyard in Central and Latin America for more silver properties, and maybe also north of the border in Canada, even though I don't think Canada has that much silver. So, I think it's all part of this drive for securing critical minerals and rare earths. And President Trump, signed loads of executive orders right off the bat when he took over last year. And it's only going to continue.
The US is expanding silver supply chains abroad at the exact moment China is restricting exports. That timing isn't accidental. As Mario Innecco points out here, governments are moving to secure critical minerals before scarcity becomes visible in price. Historically, these moves happen 12 to 24 months before supply shocks hit markets. But if silver is only industrial, why the geopolitical scramble? That contradiction signals early-stage strategic competition, not normal demand cycles. For investors, this window is where positioning matters most. Next, Mario Innecco reveals the lag between policy action and price breakout, and who exploits it.
And it's not just the US that's like, you said it's comical that they start a unprovoked war and then they sanction China, right? But I heard the EU as well is sanctioning China for selling stuff that could be used for making arms to Russia because of the war in Ukraine. And now I think China's threatening to put curbs on their exports of rare earths to Europe as well. So it looks like it's a Western disease. Our leaders and politicians, as usual, are clueless. But that always creates opportunities for, if you're on the lookout for those things, profit from their stupidity, I guess. And that's why I think there's a rush for these critical minerals because China, who's been, really grown into becoming a huge producer of not just rare earths, but all other things, they're closing the door. And I don't know if you remember, what was his name? Pozar, from Credit Suisse, Zoltan Pozar, in 2022, he warned that we're going into like a period of commodity wars because the world is deglobalizing. So I think it's only going to continue. And I think we are on the right side of things here, especially with your channel, commodity culture, right? And my focus as well on precious metals and commodities as well in general.
If this continues for another 12 to 18 months, supply shocks in critical minerals won't hit governments. They'll hit your portfolio first. As Mario Innecco points out here, China isn't just producing resources, it's strategically restricting access while the West escalates sanctions. That contradiction matters. Policy decisions are accelerating the very shortages they claim to manage. For investors, this means price volatility won't be driven by demand cycles, but by geopolitical choke points. Miss that shift, and traditional diversification fails. Next, Mario Innecco exposes the hidden trigger that turns commodity tension into full-blown price spikes.
You also recently discussed how gold's pullback could be the last buying opportunity before we go to $6,000 an ounce. What are the signs you're seeing that gold could be headed back up? Because obviously we saw all-time highs in January this year. We've seen the metal drop and kind of consolidate sideways for some time now. What do you see as that next catalyst that could bring us to 6,000?
Well, I think just the sentiment is really bearish, and whenever that happens, things go the other way, and the consolidation is like discouraging a lot of people, and that's a good thing because we got a little bit too exuberant maybe in January, towards the end of January.
Markets are calling this a cooling off phase, but sentiment indicators just hit the lowest levels since the last breakout cycle. As Mario Innecco points out here, bearish sentiment during consolidation isn't weakness. It's the reset institutions wait for before re-entry. That flips the narrative entirely. Retail sees stagnation, while smart money sees discounted positioning. If this is a final shakeout, investors sitting in cash risk missing the next leg higher entirely. Next, Mario Innecco unravels why sentiment extremes consistently mark the beginning, not the end, of major gold rallies.
And I saw recently that Turkey, they're buying back some of the gold that they sold um, because of the war. And they actually said that the reason they're buying it back is because it's very good insurance, and they were able to use it during the war to support their currency. And I think China is going to continue to buy. And as I said, the East is awake to the value of precious metals, but not the West. And I just think, we've been consolidating for almost 3 months now. It might take another month, just like last year. I think if it was from April to August, we had a consolidation between, I think, 3,500 and 4,200, and eventually it broke out. And we really went on a rampage. So I think it's the same kind of scenario, like a up and then consolidation up. And this has been happening for the last 18 months to 24 months.
Several big financial institutions are echoing your call for $6,000 gold and even higher. We've got JP Morgan forecasting 6,300, Wells Fargo 6,100 to 6,300, UBS 6,200 with the potential for 7,200 if geopolitical chaos continues. Bank of America 6,000.
Central banks are quietly reversing gold sales while publicly downplaying its importance. And that contradiction is your signal. As Mario Innecco points out here, Turkey buying back gold after deploying it during crisis proves one thing. Gold isn't legacy, it's active monetary insurance. Meanwhile, institutional forecasts cluster around 6,000 plus, but those targets often trail positioning already underway. For investors, this means accumulation phases happen before consensus catches up. Ignore that and you enter late. Next, Mario Innecco reveals why central bank behavior contradicts their own public stance on gold's role.
I mean, with Wall Street being this bullish, could $6,000 be too low of a price target? And do you expect more institutional money to pour into the gold market as a result of these big calls from Wall Street?
Yeah, Wall Street is always very conservative on their calls for higher gold price. So it is possible they're being too conservative on these calls. And I mean, my call for 6,000 is just like, it's not like the top that I see. It's just like a intermediate top, maybe in a few months or so. But I see a lot higher. And they've always had to revise going back a few years. And I think they've learned their lesson. And that's why they're calling it a little higher now. But they might even not be high enough, these calls. As for institutional buyers, I think we are seeing already, I think, the smart money is going into gold. It's more the retail investor who's still focused on the NASDAQ, on the S&P. We just made new highs on those. I'm not saying that I'm bullish the stock market, because I think in terms of gold, the stock market isn't really doing that well, even though it's rebounding right now. But there's very little interest still in hard assets, commodities, precious metals, miners. So I still think we have a long way to go, and I don't see the fundamentals changing to make me change my views. I don't see central banks acting hawkishly, like raising rates or stopping QE. If anything, they're really waiting for the chance to cut rates, but it seems to be dependent right now on this conflict in the Middle East, which hasn't been resolved.
Wall Street is raising gold targets while retail chases record highs in equities. That divergence rarely ends well. As Mario Innecco points out here, Institutional forecasts tend to lag reality, not lead it, meaning $6,000 may already be a midpoint, not a ceiling. But here's the blind spot. If retail capital stays locked in equities, the eventual rotation into metals becomes explosive, not gradual. For investors, that creates a compressed window to reposition before momentum takes over.